Morning, I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Today's webinar is part 3 of a 3-part series on the lost decade in stocks. In today's webinar, we're going to explore the 2 main drivers of the stable earnings portfolio performance to illustrate why the stable earnings core equity portfolios are an ideal all-weather core equity strategy, even in the face of another lost decade in stocks. It's not necessary to watch parts 1 and 2 of the lost decade in stocks to get benefit out of today's webinar. However, for those of you who wish to watch parts 1 and 2, you can find them in our research lab on our website at www.pacificpoint.net. Simply access the webinars section of our research lab and scroll down to the market strategy series selection. You can also go directly to YouTube and search Pacific Point. You can see both locations on the images on the left side of your screen. Simply look for the title, The Lost Decade in Stocks. Before we jump in today's webinar, let's start out with a very brief recap of what defined the lost decade in stocks. What you're seeing on the screen is what the lost decade actually looked like for the S&P 500. This is one of the premier proprietary views out of our research lab here at Pacific Point called the price and earnings chart. And what you're looking at is a nice, long, deep history of price and earnings for the S&P 500 itself. And you can see here the price line in blue with the earnings line here in orange. And you can see that period between 2000 and 2012, where that price return for the S&P 500 was effectively 0% point to point for 12 years. During which time the underlying earnings for the S&P 500 increased about 135%. But you could see that it could not outpace the PE multiple compression that actually took place from 25 times earnings all the way down to 13 times earnings. And that's illustrated by the distance between the blue price line and the orange earnings line. So you can see this wide gap here representing about a 25 multiple on earnings. And you can see that compress over time all the way down to about a 13 times multiple on earnings. Okay, so this is extreme multiple compression, which led to basically 0% point-to-point price return for that 12-year period, even despite those earnings increasing at 135%. What we determined in prior webinars is that equity risk premium actually drove the lost decade in the S&P 500. The top panel chart for the S&P 500 up here illustrates this point exactly. And you can see that multiple compression that we referred to here in the prior slide very clearly, okay? Starting out here around 25 times earnings in 2000 and ending all the way down here at about 13 times earnings. And you can see that during that same time frame, that equity risk premium actually rose from less than 2% in 2000 to over 8% in 2012. And you can see that as that equity risk premium rises, that PE multiple contracts. And the most interesting thing that we discovered in our previous webinars is that you can see how we're set up almost ideally the same exact conditions we experienced at the start of the last lost decade. So you can see equity risk premium here right at 3%, exactly the same area we were back in 2000 when the last lost decade started. And you can see that PE multiple expansion up around 19 times, again, right around that same time period, specifically in 2002, after we had the PE normalization come out as a result of valuations normalizing off the back of the dot-com bust. We're sitting right here at about that 19 times multiple. So we're really sitting right at the start of the last lost decade in terms of macroeconomic headline risk, which is what equity risk premium measures, relative to the valuations of the broader market. Okay, so the next slide, we look at the core portfolio. And this is the core portfolio for the stable earnings family of core equity portfolios. And at first glance, you'll see the same PE multiple appear, and you'll think that these results are similar. And in fact, in many ways they are, right? The core portfolio did not avoid a PE multiple contraction. You can see that our stable earnings core also contracted in the face of that equity risk premium. And again, that equity risk premium really just a proxy for macroeconomic headline risks. In other words, investors requiring more of a premium over time as this equity risk premium is rising, just to have exposure to the equity asset class. But you can see one difference, right? In this bottom panel, this third panel down here, this is the core portfolio relative to the S&P 500. And I want you to notice that even despite the fact that the core portfolio also experienced a PE multiple contraction, that on a relative basis, it didn't contract as much as the S&P 500. As a matter of fact, you can see that slope of that red line is upward sloping. So you can see that core valuations actually rose from a 25% premium on the S&P 500 in 2000 to a 40% premium by the time equity risk premium rose up to 8% in 2012. And you can read that here just by looking at these charts. So it's literally one series divided by the other. So the PEF12M here for core divided by the S&P 500, we started out right around 1.2, 1.25, which is a 25% premium. And we ended up right here at about a 1.4, which is a 40% premium, okay? So that's a huge difference. Same thing with the dividend strategy. So this is our dividend strategy for the stable earnings family of core equity portfolios. You can see, again, similar scenario, PE multiple contraction from 2000 to 2012 in the face of that equity risk premium rising. Again, our strategies are going to be, very similar in that regard. But again, the difference being that we are not going to contract as much as the S&P 500. You can see that valuation actually rose from a 27% premium on the S&P 500 in 2000 to a 31% premium in 2012. Okay, so contracting, but still not contracting as much as the S&P 500. The last strategy we maintain for the Pacific Point stable earnings family of core equity portfolios is our ESG strategy. Okay, so that's what you see on the following slide. Again, you're going to see something that looks very, very similar to what happened to the S&P 500, as well as the other two strategies in the stable earnings family. We did have multiple compression. Okay, very, very common when that equity risk premium increases. Again, that premium that investors require just to be exposed to the equity asset class rises, valuations contract. But what I want you to notice again is that huge difference here. Stable earnings ESG portfolio PE did not contract as much as the S&P 500. That's why it's upward sloping. As a matter of fact, if you follow the lines here, you'll see that this was about a 27% premium, so about a 1.27 on this chart in 2000, rising to a 31% premium in 2012. Okay. What's important to note here, when you look at the performance in the following slide, I've actually got the holdings-based performance out of our FactSet PA system. And you're looking at the performance of the stable earnings core portfolio relative to the S&P 500 SPDR ETF. And this is the actual return over that time frame for the S&P 500 on a holdings basis. And you'll see that it's about 29%. So for all intensive purposes, you can call it 0% point to point when you compare that to what the stable earnings core portfolio did over that time. So certainly we had relative multiple expansion, and we illustrated that in the previous slides. But when you look at the tremendous outperformance, it's obvious that relative multiple expansion alone cannot explain the outperformance of the stable earnings portfolios. The next two slides are going to illustrate the outperformance for the dividend portfolio. And again, remember, this is holdings-based performance. You can see the dividend strategy here at 143%. Again, the S&P 500 at about 30%. Okay. So again, we did have a relative multiple expansion of the dividend portfolio relative to the S&P 500, but that in and of itself is definitely not the reason for this outperformance. Okay, so this relative multiple expansion alone cannot explain that. So we're going to look into that here in just a minute. But this will give you an idea of how the ESG portfolio performed over that time frame. So the ESG portfolio is very, very unique. It's an ESG strategy that's designed to perform unlike many others out there that struggle. And you can see how that particular strategy did during that lost decade from 2000 to 2012. Okay, so again, ESG strategy experienced a relative multiple expansion versus the S&P 500, but there's no way that that relative multiple expansion can explain this outperformance. So the idea is, what is the reason? And that's what we're going to look at next. Okay, so what you're seeing on the following slide, we're moving into our ZAC slides now, is the actual earnings. Okay, the underlying portfolio earnings aggregated as a composite for the stable earnings core portfolio versus the S&P 500. And you can see that the stable earnings core portfolio, when we adjust it for all the non-recurring items, this is the actual earnings that we utilize to look at the underlying stocks themselves, the underlying earnings trajectory and the underlying growth rates. And you can see that for the lost decade, that growth rate from point to point was 433%. Okay, and you can see that for the S&P 500, that earnings growth was only 135%. Okay, so the very first thing that's obvious here is that this consistency of the portfolio EPS growth, right, is certainly lending a hand to explaining why that stable earnings portfolio performance exceeded the S&P 500 by such a huge margin. Okay, the fact that the S&P 500 has all of this earnings cyclicality, it's really penalizing the overall underlying earnings growth rate. And we know that portfolio valuations and stock valuations are predicated on some sort of multiple being applied to underlying earnings. And if your underlying earnings stream is consistently being penalized by going through recessions, being exposed to those underlying holdings that are more cyclically or economically sensitive in nature, then your valuations are going to suffer. And as a matter of fact, that's exactly what we experience. So point number one as to why the stable earnings portfolios perform so well over time, not only for lost decade periods, but just in general, right? All weather portfolio, regardless. We don't know, black swan events take place. We don't know what's coming down the pipe. Normally, when you have a recession, you're already in it before you realize it. That's what makes these portfolios so unique. You don't have to time your entry, your exit. They just consistently grow their underlying earnings and protect your downside. And you can actually see that earnings growth here. Okay. So again, this is the core portfolio. The next slide we're going to look at is going to be the dividend strategy. And you can see that this is really, really impressive for a dividend strategy. In future webinars, we're going to dive into each of the individual strategies, and we'll break them down relative to some of the more popular ETFs out there. And you'll see that, for the Noble ETF and, the Schwab, dividend strategy and a bunch of the others, they're going to have trajectories that look very similar to the S&P 500. And our dividend strategy, you can see, just has that much more consistent EPS growth. And this consistency in EPS growth is really one of the contributing factors that helps us explain that portfolio performance that took place during the last decade. So you can see that underlying earnings growth rate here, point to point, 238% versus the S&P at only 135. And on the next slide, we move to the ESG strategy, and you can see that similar scenario take place here. Obviously, the ESG strategy, growth strategy, 331% versus 135 for the S&P 500. And again, much more consistent, stable earnings growth than the underlying benchmark. So the next slide is super important because it actually illustrates how this EPS volatility penalizes annual earnings growth over time. And when your annual earnings growth over time is penalized, valuations and returns are also penalized, okay? So what you're looking at here is a price and earnings chart out of the Zacks research system that basically takes a look at the S&P 500 in aggregate over time, literally 25 years. And you're looking again at the price line in blue and the earnings line here in orange. And you can see that with all of that underlying earnings volatility, again, just looking at the volatility in this orange line, that annual least squares growth rate of underlying portfolio earnings for the S&P 500 only comes in at 6.67%. Okay, so you can see I have it illustrated here. The S&P 500 25-year least squares annual EPS growth rate of 6.7%. So keep that in your mind as a benchmark as we move through the next several slides and compare it to the stable earnings portfolio growth, so that of core, dividend, and ESG strategies. So moving on to the next slide, you'll see something very different. You'll see how that underlying portfolio earnings stability, okay, lends a hand in not only the performance, okay, so again, we're looking at that 25-year history of price and earnings out of the Zacks research system. But what you're going to see is that because we don't have those earnings troughs through these recessionary periods, and even outside of recessionary periods, we don't have any earnings troughs, that 25-year annual least squares growth rate comes in just shy of 13%. Okay, so if you were to pull out your calculator and calculate the delta or the difference in the growth between the core portfolio annualized over 25 years versus core versus the S&P 500, you'd see that the core portfolio grows its underlying earnings on average each year in excess of 90%. I think the number is closer to 94% difference. So the difference between the 12.92 and the 6.67. Okay, that's a huge difference. Okay, so again, 25-year least squares annual EPS growth rate 12.9% versus 6.67 for the S&P. Apply a multiple to that, and obviously you can see where that outperformance is coming from. Okay, and as we're looking at these slides, pay attention to the actual price series here. You can actually get an idea of your point-to-point price return. You can see the start of 2000 here. By the end of the last decade, you can see that we've got significant price appreciation by the end of 2012 because we're not going through those earnings cycles. Okay. Next slide is the dividend strategy. The interesting thing here is I want you to note that those earnings actually accelerated quite substantially through that lost decade period. And really impressive for a dividend strategy. Most dividend strategies tend to be very value oriented, tend to be very cyclically oriented, a lot of energy name exposure, a lot of bank exposure. You can see that again, 2000 to 2012, we actually had really nice price appreciation for a dividend strategy, super impressive. And when you compare that 25-year least squares annual EPS growth rate, 8.66%, relative to the S&P 500 at 6.67%, it's about a 30% increase. And that's just super impressive for an income generating equity strategy. So we're super happy with the dividend strategy. It's one of our very popular strategies. ESG, again, just a tremendous growth strategy here. You can see that underlying earnings stability for the portfolio, and it's clocking in on a 25-year least squares annual EPS growth rate of 12.1%. You can see that's basically greater than 80% growth over the S&P 500 each year on average over the past 25 years. Okay. So in conclusion, right, we look at the lost decade in stocks for the S&P 500. We can see that underlying EPS growth, okay, so you can see this cyclicality in this orange line here, and the fact that because we had all of these earnings cycles, that underlying EPS growth actually failed to outpace the PE multiple compression, that valuation impact resulting from, I should say, resulting in little to no point-to-point price return for the S&P 500 between 2000 and 2012. So you can see those two periods here basically flat. And again, the reason for that is that we had EPS growth, okay? We looked at it in previous slides. It was about 135%. But even despite that underlying earnings growth, it was not able to outpace the impact of the valuation compression that resulted in this PE multiple contraction that took place over time. And you can see that, just look at the distance between the price line in blue and the earnings line in orange over time. You can see that multiple getting smaller and smaller and smaller. And again, if you were going to experience price appreciation over that 12-year period, you're going to need this orange earnings line to be much higher, to grow at a much steeper trajectory with much less cyclicality. And that just didn't happen for the S&P 500. It didn't happen for most strategies out there. Okay, it was a really, really tough time. Anybody that was managing money during this time, they were pretty much pulling their hair out. And so this was basically the result of, you know, the performance for the S&P 500. So when we look at the stable earnings family of core equity portfolios, we see something very different. And again, in conclusion here, we're looking at the two reasons for this outperformance. And it should be pretty obvious by now that underlying earnings consistency, okay, being point number one, right? Very, very important in driving point number two, which is that actual EPS trajectory, that annual least square, that 25-year least squares annual growth rate of earnings being, you know, in the case of core, in excess of 90%, in the case of ESG, in excess of 80%, and even our dividend strategy being able to beat the underlying S&P earnings by an excess of 20% or so is just super impressive. So those are the two main reasons why the stable earnings family of core equity portfolios were able to perform so well during the lost decade in stocks. And again, regardless of whether we have another lost decade in stocks, we never know when we're going to be facing a black swan event. We never know when the next recession is really going to take place. And you can see that this portfolio, as far as a foundation for your core equity allocation, in terms of a core portfolio, is just extremely well suited. You can sleep at night. You and your clients can sleep at night if you're a financial advisor. You don't have to worry about timing the market. And you can see that even though in general, again, we're looking at core here, but it's the same scenario for the dividend strategy and the ESG strategy, regardless of the fact that we still had multiple compression. You can see that, right? The distance between the blue line and the orange line, even for our stable earnings family, it did compress, right? We did have valuation contraction. But because the underlying EPS growth rate was so consistent and it was so much greater, in other words, you can see the slope of that orange line being so much greater than the S&P 500, so it grew faster. We were able, when you apply a multiple to that, you can see that you're able to get appreciation out of your portfolio, okay? So this is significant, and one of the reasons why these strategies are so extremely popular. If you're a financial advisor or an individual investor and you'd like more information on how you can gain access to the stable earnings family of core equity portfolios, please email us directly at info@pacificpoint.net, and be sure to connect with us on LinkedIn @Pacific Point Advisors. Thank you all for attending.